Vijai Mantri, Managing Director and Chief Executive Officer of Pramerica Mutual Fund. Vijay, good morning and thank you for joining us. Vijay, exactly a month ago, traders and investors had no reason to sell into this market. Now there is a laundry list of why one should not own stocks: China, emerging market volatility, flows and political uncertainty.
I think if you, it could be divided into two parts. One part, if you look at the emerging market, and second part, we come specific to India. If you look at the emerging market, there's a growing concern that the economy of various emerging markets may not grow as people expected them to grow. And largely it is driven by if US start tapering, which it already started doing, and by all indication by 2014 all the tapering will be over. So in that context, the kind of money available to the emerging market to grow their economy will not be available. And right now most of the economy and GDP expansion happen because a lot of easy dollar available. I think that would not be available to that extent. So there's a concern coming, and that is the reason that you see most of the institutional investors from international markets are booking profit from emerging market. And hence India got little disproportionate share for many years, including last year. And India is a market where currency has not depreciated in last 3-4 months. So that is the reason that you see more money actually being taken out from India. And we'll continue to see that happening maybe for next maybe couple of weeks or so. And then perhaps the market will stabilize around, in our opinion, anything between 5600 to 5700 level of Nifty. But interesting thing is the range of the market is moving. Earlier it was 5,200 to 5,800 level. Now it is at the bottom we are talking about 5,007, at the top 6,300 kind of level. So the market will move in the range, but the range is actually getting upper and upper as the time progresses.
Vijay, what's the sense that you're getting about local fund buying that we are now seeing into high beta pockets, you know, the likes of real estate as well as metals, which has been evident at least in yesterday's trading session? Are these pockets that you would venture in or stay away purely because of the volatility or rather volatile nature of these sectors?
I think you're right that a lot of money, domestic money and particularly smart money, either may be moving towards cyclical or maybe in the mid and small cap segment. And the reason is very simple, that where is a big PE expansion is going to come by, and definitely they're going to come by in the cyclical. But the way we have looked at a portfolio is that if you look from a valuation perspective, many of these stocks looks very attractive, from a historical valuation perspective as well as the current value of these stocks that are available at very attractive price. But the thing is that a lot of these stocks are to large extent depend on what happen on the policy front. If there's no clarity, which we do not see going to happen over next till the next general election, I think we would be comfortable missing out on 10-20% gain, immediate gain. But we would look at getting more clarity on many of these stocks, because in our opinion these stocks are not 20-30% kind of gain stock. They are, in our opinion, 2 to 3 time kind of a stock. So from our perspective, we are right now not owning those stocks, and actually we are underweight on the metal and many cyclical companies.
Vijay, how big is China? The street is divided on what China could do and the influence China could have on global markets for next 2 or 3 quarters.
I think there are 2 big structural changes which is Chinese economy or Chinese policymaker themselves have started doing it. One is that their focus would be more on consumer-driven growth in the economy rather than the investment-led growth. If that is the logic, then if you look at most of the commodity, China consume around 1/3 to 2/3 of the most global commodities. So that will have an impact, in our opinion, on the metal stocks and many cyclical stocks. So China will continue to play a very interesting role. And our opinion is that we are not in the extreme situation, we are in the middle. And why we are in the middle? For very simple reason that we believe China is going to continue to play the role, but perhaps there's a lot of uncertainty now the stock which can impact because of what is happening on China. Either in the given situation we could be equal weight on those stocks or we could be underweight, but there's no reason we should be overweight in the stock which have direct impact of what happened to the Chinese economy.
Which means no metals, no manufacturing companies, no Tata Motors for you?
We are underweight on most of these companies. We are underweight on metal, we are underweight on many auto companies, and we are underweight on many manufacturing companies right now. Because you have seen, Nikun, the result. If you look at result, clearly it could be divided into two parts. One, you have IT and pharma company delivering robust growth top line as well as bottom line. And if you look at cyclical and many manufacturing companies, there's continued to remain challenge on growing their top line, bottom line. The headwind right now is very much there, and there's no light at the end of the tunnel which shows that these challenges are going to go away, the headwind is going to disappear. We don't see that happening. And even let's argument's sake assume that there is going to be a stable government in May 2014. Even that government will take time to revitalize the economy and bring right kind of changes. So we need to wait, and we need to wait and see what happens in the election, because still they are close to 75 days before the election, and I think the biggest trigger in India is going to be general election.
Given me a perfect cue to frame my next question. If you feel that the economic concerns both locally and globally are here to stay, why should one invest into equities at all at a time when government bonds are giving you 9% tax-free return?
I think you have a point. To certain extent, that's why a lot of money is also moving get invested in government bond. But if you look at the household balance sheet today, I think it is historical low as far as equity participation is concerned. So you have a lot of money stuck up in real estate, a lot of money got stuck up in gold, and a lot of money is got invested in bank deposit or tax-free bond. Now, the ownership of domestic is so low. So any volume, any pickup of demand from domestic investor in these segment actually increases the stock prices. So that phenomena we are seeing actually right now in the mid and small cap, where I don't think FIIs are buying. Most of the buyings are happening from domestic investor. So that's the one reason. The second reason is that the smart money is moving toward these ideas, saying that yes, we understand the government is offering 9%, but I have a lot of money stuck up in all these products. Let me look and take a call on equities. So the domestic money which is coming in actually is not looking at 8 to 9% or 10% kind of appreciation. They are looking at 2 to 3% 2 to 3 times of gain, and that is the reason that a lot of this money is being invested in cyclical, and people have patience to wait for 2-3 quarters, because by that time, if things happen, the price will already be maybe 20-30% up in mind of some, in the opinion of some people. And that is the reason that smart money is moving toward these stocks, and strong hands are owning this stock. It is not that the Aam Janta and the whole crowd is participating in this. So that is the reason. So anybody who's not have a full conviction may not be investing right now, but there are some people who are taking a leap of faith.
Vijay, what is the best way to bet on the Indian, consumer story? The easy way is that you buy into FMCG stocks, you buy into consumer staples, you bet on auto discretionary. Staples are expensive, and discretionary, which is autos, they are going through a cyclical slowdown.
Perhaps it is not the right time to be too much going on the India story, because one is the macro front, there are challenges, and the government has to meet its fiscal targets. So what will you see is that there's the expenditure slow down, and that will have impact on money available across the industry. Private investments are not happening. So, and what we have seen that even in rural India, the demand slowdown and the sign of demand slowdown are visible. So one has to be very selective right now, and in our opinion, best way to play India's story is to invest in the companies which are going to benefit significantly from the global recovery, and we are betting on those kind of companies.
Only IT and pharma, Vijay. I mean, if you're betting on global recovery, you can buy IT and pharma. These stocks are already expensive, and there is so much of IT and pharma you can buy in your portfolio.
Yes, but you can hold cash in your portfolio, because I do not think that even if you look at the FMCG sector, they are available at 30-35 P multiple, and compared to that, if you look at IT pharma company, they are available anything between 15 to 25 P multiple. There's a more visibility on the top line growth as well as the bottom line growth. And there's a significant cost saving these companies are going to have because they have a great arbitrage right now. The global demand is increasing. The domestic lease rentals are falling, and the expectation of the employees down quite significantly. So, and you see visibility of these things happening in the earning of these companies. So the market look at the certainty on the cash flow, and from that perspective, these companies are in a good shape right now, and that is a very simple reason we are owning, and we continue to be bullish on these companies, at least for the time being, until and unless we see definite sign that the cyclical are here to play a big role. In my opinion, if you look at 3 to 5 year period from now, I think the big PE expansion, the big recovery in the market would be led by PSUs, companies, or by the cyclical stock. But perhaps this is not the right time to own these stocks. At least one need to wait for some more time.
Vijay, what's the sense that you're getting about the auto space? Of course, yesterday on account of the new launches at the Auto Expo, some sentimental rub-off as well, and some decent numbers coming in from the monthly sales data. JLR sales volumes actually held out. So good traction coming in yesterday in the entire space.
If you look at auto, if you look at the international demand for the product which Indian auto companies are producing, I think the numbers are looking very good. But I think the bigger challenge is basically what is happening on the domestic side. And in domestic side, you look at any segment of the market, I think they are struggling. Whether you look at a commercial vehicle, or you look at the cars, or you look at scooters, all the segment, I think they struggle. Is there? And the reason is very simple, because of money available in the hand of consumer is going down. There's uncertainty about the job. People's incomes are not increasing. The working cycle is getting stagnated. So I think all these reasons are leading people to either postpone the buying decision or wait for some more time where they say more visibility on their own earning. So I think that would continue to remain. I think the silver lining is very clearly, if the metal prices continue to go down, then over a period of time, auto industry as well as the manufacturing industry going to see some savings happening. And I think interest rate to us looks like peaking out right now, or maybe in maybe 1 or 2 quarters they will become peaking. So if the interest rate come down, then I think that will have a cascading effect on auto industry. So, but right now one need to wait to be over aggressive on these counter right now, and we are underweight on the auto because of these reasons.
Which I just want your views on Cognizant and as to how it seems like the global IT growth is now petering down. Does it seem like this could kickstart a wave of profit taking for our IT space as well, which has been the case in the last couple of trading sessions?
Can't comment on an individual stock, but what happens if the global flows goes out, which is what we are witnessing in India over the last couple of weeks, then definitely they'll take money out where they made the maximum money, and the maximum money is being made in IT industry. And if you see domestic buying and FI selling, domestic would buy and FI would sell where they have the holding, and the large holding is in actually IT and pharma sector. So that is one reason that you've seen that happening. But we do not see significant risk to the IT company which we own on portfolio. That we have seen the December quarterly result, and most of the IT company results were ahead of expectation, and their earning guidance is also pretty decent. So we bearing 1 or 2 company here and there would happen in every sector. I think the IT still is a good space to be in, and if there are correction because of the global flows are going out of those stocks, I think we would be looking at buying on dips in these stocks.
Vijay, but unfortunately trees don't grow to the sky. IT stocks already have seen an extraordinary run-up. From 2008, TCS is up 8x. HCL Technologies is up 3x in last 2 years, and Infosys has appreciated by about 50-60% from the recent low. Some would argue that a lot of good news is already in the price.
To certain extent, yes, but again, the growth in these stocks has happened because they have shown the profit growth, and they have shown the profit growth when the environment was very challenging. Now we see all the headwind around the IT companies is slowly disappearing. As I told, from a vicious circle they are moving into virtuous circle, and that is the reason the market is paying the price to these companies, and we continue to believe until we see Either you own IT pharma right now or you hold cash. We don't see any reason why one need to look at start owning cyclical and government-owned companies right now. So that is what a lot of portfolio managers are also doing.
Vijay, good chatting with you. Really appreciate you taking the time out and speaking with us.